Gold hits record highs after the US sets tariffs on imports of gold bars. All eyes this week are on an expected rate cut in Australia tomorrow and US inflation data tomorrow night. That's coming up in our 5 Things in 5 Minutes on Monday, August the 11th. And in our deep dive interview, ANZ Head of Australian Economics, Adam Boyton, has gone hunting for the neutral interest rate.
The current cash rate of 3.85 isn't a million miles away from neutral, that it's probably a couple of rate cuts away from neutral.
But first, in 5 and 5 with ANZ, the gold price hit record highs on Friday night. That's after the latest tariff drama revolving around US importing gold bars, with the US Customs and Border Protection Department ruling on Friday that 1 kilo gold bars and 100-ounce bars are subject to tariffs. That would hit Switzerland hard with its 39% tariff and India with 50%. Switzerland has been a major source of gold bar imports to the US in recent months. Here's ANZ Group Chief Economist Richard Yetzinger on the ongoing uncertainty about tariffs.
The key point out of all of that is, even though we have a pretty good scope of the landscape for tariff rates now, I don't think we'll ever be able to presume that they're set in stone and we can move on to other things. Switzerland seems to be a bit of consternation from the US about Switzerland's role in producing the gold bars that the US imports, and potential tariffs encouraging the production of more imports and hence more gold bars. It seems a bit strange for the US to be upset about that when actually it's the tariffs that caused the spike in buying.
As of 4 a.m. Sydney-Melbourne time, gold was closed on Friday night at $3,491 an ounce, up 1.1% on the day, and just below a new record intraday high of $3,534 an ounce. The S&P 500 closed up 0.8% and the Nasdaq rose 1%. The US 10-year Treasury yield rose 4 basis points to 4.28%. West Texas oil futures closed flat at $63.88 US a barrel. The US dollar index fell 0.2%. The Aussie dollar, though, was flat at 65.26 US cents, and the Kiwi also flat at 59.60 US cents. Number 2. Richard says India's predicament with 50% tariffs seems to be a result of Trump's transactional approach. He has one suggestion for why India has been hit so hard.
One question I have is whether the Trump presidency is going harder on tariffs with economies that don't buy much US debt, whether that has arisen as an issue after the bond market ructions of April and so forth. Again, a transactional approach to things would be, if you thought funding the US deficit was a weakness, well, favour the countries that do most of the funding and then get more tariffs from those who don't.
Number 3. The first big event to watch for this week is the Reserve Bank of Australia's cash rate decision tomorrow afternoon. Here's ANZ Head of FX Strategy, Ajabin Zaman, on how the Australian dollar is set up for that.
We do expect that cut to come in for 25 basis points, but that is largely priced in. I think the short-term reaction to the meeting will really come down to the tone of statements and comments from Governor. July's surprise hold and cautious outlook from the RBA saw a short-term rally in the Aussie. We think more dovish than expected comments from the board, including possibly acknowledgement of the softer CPI or the weaker labour force survey data that we saw may weigh on the Aussie.
Number 4. The other focus in current markets in recent days was the appointment by Donald Trump of Stephen Moran to a vacant seat on the US Federal Reserve Board.
We know that Moran has been pretty critical about the Fed. He has proposed changes to the central bank where, he says that the central bank has had policy errors before because of groupthink and that they should be separated into different teams. Monetary policy board should be separate, regulation should be separate, and all of that. Initial reaction to that has seen the dollar weaker, but looking ahead this week, at the margin, we think there is a little bit of a risk of recovery. The reason for that is because we have the CPI coming out this week.
Number 5. On that issue of US inflation, ANZ senior international economist Tom Kenny is expecting core inflation of 0.3% in the month of July, giving an annual rate of 3%, which is well above the Fed's target for 2%. Tom expects higher tariffs will finally start filtering through into higher inflation.
Firstly, we just saw last week significantly higher reciprocal tariff rates set. Secondly, business surveys suggest margins are being compressed, and we think it's only a matter of time before firms try to recoup some of that lost margin. And thirdly, the stocks businesses pushed ahead of tariffs has largely run out now, meaning that businesses face higher import prices.
Tom Kenny there. Now, in our deep dive interview, ANZ Head of Australian Economics, Adam Boyton, has looked at recent productivity figures as a way to work out what Australia's neutral cash rate is now. Australia's measured productivity growth has been slow at around 0.2% per annum in the last decade, versus the Treasury's medium-term view of about 1%.
There are a couple of interesting things that are going on there. And the first is that we have had a big increase in what we call the non-market sector in Australia over the past sort of half decade or so. The non-market sector being healthcare, education, public administration and safety. Now, this non-market sector, at least in the productivity data, is sort of recorded or measured as having a low level of productivity. Now, I'm not saying that these aren't valuable activities necessarily, but at least mathematically, if you increase the size of a sector that has a low level of productivity, everything else equal, you'll drag down aggregate economy-wide productivity growth. So if we then look at what's happened in the non-market sector, you see slightly faster productivity growth over the past decade. There's also a story to tell around the mining industry where two things are happening. The first is that the level of productivity in the mining industry has declined quite a lot over the past few years. And the second is that the mining industry is getting smaller as a share of output. This latter one matters because productivity in the mining sector is enormous. If you think of the mining sector, it's hugely capital intensive, doesn't need that much labor, and of course productivity is defined as the amount of stuff you produce for any given hour worked. I should say that's human hour worked. And so in the mining sector, it's the machines that are doing an enormous amount of work, hugely capital intensive, and so that small reduction in the mining sector's share of the economy is also working to lower aggregate productivity. If we look, say, at productivity in the non-market sector, excluding mining, so think about, the individual business level, you actually find over the past decade productivity growth per year in excess of 1%, which is a much more positive story than what that headline number's telling you.
What has that meant for the nominal neutral rate that the RBA has to think about to make sure it's not either speeding up the economy or slowing it down in a way that means it misses its inflation targets?
What we've done is have a look at which productivity measures really matter for the neutral cash rate. Given that there is this sort of divergence, if you will, between economy-wide productivity ex mining, or market sector productivity with or without the mining sector, you've got four different potential measures of productivity there. So what we did was examine which ones of those tend to have the strongest correlation to the average real cash rate as a proxy for the neutral cash rate. And what we find is that it's the ex-mining measures of productivity that have the strongest relationship. And so the other interesting thing about those is these ex-mining measures of productivity are showing faster growth post-pandemic than pre-pandemic, which tells us everything else equal, the neutral cash rate will be higher than it was before the pandemic.
And so all of those things mean the neutral cash rate is a little bit higher than it was before the pandemic. And what is it and where does it compare with the official cash rate now? What might that mean for where the official cash rate goes?
So we end up with two estimates. One of them is 3.9% for the neutral cash rate. Now that's going to sound high, I think, to most people, particularly given the current cash rate's 3.85 and the Reserve Bank described that as being a bit restrictive. So I'd put that at the top end of the estimate. And then the other estimate we arrive at is 3.2%. Previously we'd been thinking in a very judgment-based way that, say, 3.25 to 3.5 was probably where the neutral cash rate was. This work, I guess, is reasonably consistent with that, falling out with a 3.2% estimate for the neutral cash rate. And indeed, if I read between the lines of the Reserve Bank's July board meeting minutes, it would seem that their preferred estimate of the neutral cash rate is a little over 3%. So let's call it 3.25. We'll do a bit of rounding. What that tells me is that the current cash rate of 3.85 isn't a million miles away from neutral, that it's probably a couple of rate cuts away from neutral.
Adam Boyton there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, August the 11th. Catch you tomorrow with a closer preview of the RBA's expected rate cut. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.